Joining us now, George Tsilis, Senior Markets Correspondent. George, what'd you make of these numbers?
Well, I think in context, they're actually better than estimated. I mean, we have to consider first that Oklo is, as a company, not generating revenue yet. They are estimating to begin scale production of their small modular nuclear reactors, which are site-specific, and I think it's very important to consider the benefits to this technology. I mean, first off, because the existing infrastructure for electricity generation and distribution is very limited, so having site-specific small modular nuclear reactors is going to benefit those data centers that need on-site electricity on demand. So that's something interesting you have to consider for this whole industry space. But looking at the EPS for Oklo, they did come in better than estimated. The loss estimated was close to 11 cents. They came in around 7 cents, which was actually an improvement from last year for the same quarter where they lost 34 cents. And if you do the math for the company, irrespective of the fact they're not generating any revenue yet, just look at the market capitalization, around $4.5 billion. This was as of the close yesterday. And for the quarter, they did report an operating loss or expense of around $17.9 million. So if you just round up, it's around $18 million. And you annualize that, it's roughly around $76 to $78 million. And if you take that loss relative to the market capitalization, there's a negative earnings yield, but it's not very large. And I think that's important to consider when looking at this whole space, because you are seeing other companies out there that are competitors to Oklo not generating revenues, but are generating much more significant losses relative to their market shares. And those are the companies that I suggest maybe are going to be under more pressure versus Oklo, which may be still under pressure because of the negative earnings yield, but nonetheless, the pressure to dilute shares is a lot smaller.
Hey, George, do you have any update as to the timeline of starting to see some of these projects actually being fully implemented here and when they might actually generate some top-line revenue? And then also, do you think investors might be getting ahead of themselves when, 10 years from now, when this company's up and running, it's still a utility company, it's still a power generator, it's not a technology stock or anything of that nature?
Well, I mean, so yeah, I think this is an interesting space. Obviously, it's not going to be part of a public utility business, where it's essentially covered in terms of how much they can charge or sanctioned and regulated, how much they could charge their customers. I think the marginal demand for electricity, particularly the data centers, are going to be from companies like Google and Amazon that are going to pay a premium for electricity. And so these are interesting technologies if you can actually get the regulatory approval, as well as, dealing with some of the regulations, safety concerns, national security concerns, because you're dealing with radiation on these specific sites. There's a lot of red tape that the company has to go through to start generating revenue. Now, based on what they say they're not going to be doing so until late 2027, early 2028. So for what it's worth, we're talking at least a couple of years down the road, and that's quite far in terms of reach and visibility in terms of earnings and sales. And so, the price is moving first, obviously, and the price is moving off of the lows that we saw in April because the market is catching a bid and we're in a risk-on environment. But, irrespective of that, the stock price could certainly continue higher. It's not a very large market capitalization stock. It's still highly shorted, but the short interest has actually gone down. Going back a couple of quarters, there was around 18% of the free float. Now that I last looked, it's around 10%. And I think the shorts are looking at this carefully because, like I said, if you just analyze how much they're losing per share, which the losses are improving. They're not as bad as they were last year. Mm-hmm. Relative to the capitalization of the business, the negative earnings yield is low. And so for what it's worth, it doesn't necessarily mean it's going higher or lower. I'm saying is that the risk of dilution, severe dilution in this name is a lot less than perhaps other names out there that are not as well capitalized.
So, George, I'll ask the question, then you've talked to us a lot over the years about tradable and investable. Is this making the transition then, mm-hmm. based off that last piece of information you've just been saying?
Well, I can't provide my opinion. I will say this, that just based on my experience, that generally speaking, stocks, particularly those that are not generating profits, will go about 6 quarters out. So, if they say as a business, we're talking late 2027, early 2028, we're already about 2 to 2.5 years out. So, from an investment standpoint, I can't say, I'm not going to say it's still too early, because at the end of the day, they do have a technology. They just don't have the regulatory approval to start deploying that technology and then generating electricity for the end users, which are going to pay a premium for the electricity. Those data centers use tremendous amounts of power. But again, they're facing some of those regulatory hurdles they need to overcome.
Yeah, 114% implied volatility, maybe rightly priced, then reflecting sort of the maybe breakthrough technology they're working on, but also the fact that maybe it never comes to fruition or takes longer than those are hoping at the moment. George Tsilis, appreciate it as always, senior markets correspondent for the Schwab Network.